Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 12, the group B problems. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so let's see here, problem 40. Get my pen. All right, so it says calculate various ratios for analysis. So here's my income statement and my balance sheet, giving me multiple years of information. Other information, the market price of the common stock was $48.72 on December 31st, 2014 and $33.28 in 2013. Average common shares outstanding were 11,000 during average common shares were 11,000 during 2014 and 10,000 during 2013. So it says here, compute the following ratios for 2014-2013. Round the two decimal places, assume all sales are on credit. All right, so let's just work through these and then we'll worry about 2 and 3. And I'm only going to work in this one small space here. So I'm going to pause the videos, okay? All right, so again, we're going to start out with here our current ratio. And so current ratio is our current assets over our current liabilities. And so for 2014, our current assets are 374,000. Oh, that's twice I did that. 374,000, and that's divided by our current liabilities of 210, and that gives me 1.780. And for 2013 we have 363 over 231, which gives me 1.57. Okay, so now I'm sure, okay, number 2 here says decide whether Barton Furniture performance improved or deteriorated. Right, so I'm not, you're going to need a, actually let me kind of do it up here then. So I'm going to put 2014 here and 2013 here. And I'm going to just try to list the information here. So my current ratio is 1.78 and 1.57. All right, I'll try to list the data here. All right, so pause the video. I'm going to erase this. And then our inventory turnover. Inventory turnover is equal to the cost of goods sold over the average inventory. So our cost of goods sold for 2014 is right here, 241,000, and that's over our average inventory. Well, look at our inventory, and we have, remember, the ending inventory for 2013 becomes our beginning inventory for 2014. So 154,000 plus 165,000, and that's all divided by 2. And so 154 and 165 is 9, 11, 319 divided by 2, 159.5. So that's 159,500, and when I do the math on that, that ends up being 1.51, right? 214 divided by 159.5 gives me 1.51. do the same thing for 2013. We have 231, and that's over. Okay, so our ending from 2012 is 191 plus 154, all divided by 2. So 191 and 154 is 345,000 divided by 2. That's 172,500. Divide 231 by 172.5, and I get 1.34. Right, so inventory turnover is 1.51 and 1.34. Let me pause the video because I'm going to erase it. All right, next is the accounts receivable. Oh, darn it. Okay, sorry about that. Occasionally we have technical difficulties and we crash the computer, which is what happened. So at least I didn't lose too much information here, and I can recreate it. So my current ratio was 1.78 and 1.57. My inventory turnover ratio was 151 and 134. Okay, so that took care of that and that. So our accounts receivable turnover ratio is the net credit sales divided by the average net accounts receivable. So our net credit sales, remember all sales are on credit based upon the information right there. Assume all sales are on credit. So for 2014 we have 241, and that's divided by our average net accounts receivable. So our accounts receivable net is here. So 89,000 plus 86,000. Divide that by 2. So 89 plus 86 is 15. 175 divided by 2. That's 87,500. And when we divide 241,000 by 87,500, we end up with 5.62. And then we're doing the same thing again for 2013 by taking the 231 and dividing it by 102 plus 89. I'll divide it by 2. So 102 and 89 is 1191. Divide that by 2, 95500. 95,500. So take 231,000, divide it by 95,500, and we end up with 4.70. Okay. So our accounts receivable turnover is 5.62 and 4.70. And so pause the video because I'm going to erase it. And notice it's just, all this here is just number crunching, being able to find where the numbers go. This is just practice. If you've worked through the homework problems, this, for me, this is just boring work, honestly, because I've just done it so many times, okay? But, I was in your shoes at one time, and, the hard part here is okay, here's my formula. Which number do I pick? Now, obviously, when I'm doing 2014, if I understand how to choose the numbers for that particular ratio for 2014, then obviously doing 2013 is a little bit quote-unquote repetitive. It's just number crunching. So this can be a little bit boring, right? But That's how you get good at it, right? Just by keep on doing it, right? So our interest coverage ratio is equal to our earnings before interest and taxes divided by our interest expense. Okay, so for 2014, our income before, let's see here, we have our income from our operations, then we have an interest expense, so then we have our interest before income and taxes, right? Then we have our income tax expense, and then we end up with our net income, right? So we're looking at earnings before interest and taxes. Well, here's our interest, and here's our taxes. So what are earnings before, right? That's the income from operations. So I have 108, and I'm dividing it by the interest expense, which is the 10,000, right? 108, and there's the 10,000. And so divide one by the other, and I get 10.8. And same thing for 2013, I have 80 and 16, and that gives me 5.0. So our interest coverage ratio is 10.8 and 5.0. Okay, so pause the video. All right, our return on equity is our net income divided by our average stockholders' equity. Okay, so for 2014, our net income is 65,000, and we're dividing it by our average stockholders' equity. So our common stockholders' equity, no par, and we're taking an average, right? So I have the 193 plus the 228 divided by 2. So 193, 228, 11, 12, 4 divided by 2 is 210,500. So that's 210,500. So I divide, let me just make sure that's right. So that's 2, 1, 0, 5, 0. Let me do the math on the calculator. 421,000 divided by 2. Right, 210,500. Right. So 65,000 divided by 210,500 gives me 30.87%. So 65,000 divided by 210,500 gives me 30.87%. 88, round it. Okay, and then for 2013, excuse me, I have 42,000, and I'm dividing that by the 198 plus the 193 divided by 2. So 198 and 193, 11, 18, 19, 3, 191 divided by 2 gives me 195,500, 195,500, and divide one by the other, and I get 21.48%. So my return on equity over here, I'm going to put the 30.88% and the 21.48%. Okay, pause the video because I'm going to erase this. So let's see here. That's return on equity. So now we have earnings per share of common stock. So earnings per share is net income over average number of common stock, shares of common stock outstanding. So our earnings per share, our net income is 65,000, and our let's see here, market price, average common shares were 11,000. Okay, here's where I'm getting that number from for our average number of shares of common stock outstanding. We were given that information. So 65,000 divided by 11,000 is 5.91. And remember, this is not thousands, all right? This is earnings per share, right? Earnings per share. And then for 2013, we're looking at 42,000 divided by the 10,000 for 2013. And that gives us $4.20 earnings per share, right? So my earnings per share is $5.91 and $4.20. Okay. So pause the video. I'm going to erase that. And then lastly, the price to earnings ratio, the PE ratio. Okay. So the price to earnings ratio is the current price per share over the current EPS. So our current price is $48.72, and we just calculated the earnings per share of $5.91. Right. So that gives us a price to earnings ratio of 2.86 for 2014, and the price in 2013 was $33.28, and the earnings per share was $4.20, and that gives us 7.92. Okay, now we have 8.26 and we have 7.92. Okay, I'm going to pause the video and erase this. Okay, so now that we've went and calculated all of these here ratios, and remember, this is basically what financial statement analysis is. You know, you have the raw data from your financial statements. Okay. Then you ask yourself the 5 key questions, or you ask yourself certain questions, and you do the ratio analysis. You look at those ratios and you use that raw data from your income statement, your balance sheet, in order to come up with the ratios. And then having the ratios, now you try to answer the questions that you're asking yourself. All right, and that's where, quote unquote, the real analysis is interpreting the data. Right. So it says here, to decide A, whether barn furniture's performance improved or deteriorated during 2014, and B, whether the investment attractiveness of its common stock appears to have increased or decreased. Right, so when we look at this, now remember, you're having a ratio, one number in and of itself. Like if I was just looking at 1.78, it doesn't really mean anything in and of itself, but it does mean something in comparison to something else. So, you know, for the current ratio, that increased, our inventory turnover, that increased means, what does each one of those particular means? Now, each particular ratio means, well, what does the current ratio mean? Oh, it's my current assets over my current liabilities, which means I have more assets to pay off my liabilities. I'm turning over my inventory a lot quicker. My accounts receivable turnover, I'm getting them to pay a lot more because that increased. They're paying a lot quicker, okay? And my interest coverage ratio means I have enough money to be able to pay, the interest. So, all four of those factors increased. So I would say that for Barton Furniture, its performance improved from 2013 to 2014. Okay, with the attractiveness of the common stock appears to have increased or decreased. Well, my return on equity increased, my earnings per share increased, and my PE ratio increased. All right, so that all says that improved. So it's becoming more attractive. Now, again, this here, when you're looking at this this problem, and I don't know if it's because of the problem itself, but you don't necessarily always have an increase or a decrease in all of your ratios. Sometimes some are going to increase, sometimes they're going to decrease. The ratios are going to decrease. And you'll have to really think about, and that's where understanding the meanings of the ratios comes in. All right, if you understand what the ratios are measuring, and even though you might have an increase, decrease, increase, decrease, decrease, you might have something like this, your interpretation of those ratios will decide whether, like in this case here, whether things are improving or declining, or you use those ratios to determine, answer whatever question is that you're asking. It's never going to be, it doesn't necessarily mean it's always going to be just as easy where I have all pluses, all increases, or I have all decreases. It doesn't necessarily mean it's going to be like that. You have to go back and interpret that data, and that's just something that you have to think through. There's nothing that anyone can tell you when you're, can help you out with. I mean, yeah, you can discuss it with somebody who knows more than you or understands a little bit better than you, until you can get up to that level of experience to be able to provide that same type of information. Right? So number 3 says, how will what you learned in this problem help you evaluate an investment? Right? Which is kind of like what I'm just been trying to get at. The solution says this problem gives you practice in computing and evaluating several of the ratios in the financial statement analysis. By analyzing a 2-year trend in the ratios, you can see whether a company's ability to pay its debts, manage its assets, earn a return on it for investors has improved or deteriorated during that period. Improving ratio values generally indicate an attractive investment, and deteriorating ratio values usually signal an unattractive investment. But like I said, you're not necessarily always going to have all pluses or all minuses. Okay, you're going to have a mixture of the two, and by understanding the meanings and what makes up the concepts, the ideas that make up those particular ratios, right, you're going to have to work through and think through the each and every one in order to be able to determine the answers to your question. All right, so that's it for this particular problem. And I know it's a little bit long, but yeah, this is what a financial analysis is about. It does take a lot of time because you do have to crunch those numbers in order to be able to arrive at it. I mean, if you were just given the ratios here, then a minute or 2 or 3 for you to think through what the ratios mean to answer your question is all it would take. But it is a lot of number crunching when you're doing analysis, and unfortunately that's just the nature of the beast. So it has to be done, and if you're not doing it, and you notice that if you don't really understand the ratios or you're picking the wrong numbers, then you're going to, something that you did way back in the very beginning, let's say, you made a mistake doing your totaling up, say, your current assets, okay, and well, you're going to start throwing things off, and you're going to start skewing your results. Right? So it does have to be accurate, and depending upon the question that you're asking, you can make if you make a mistake in one area, it may or may not affect whatever question you're asking. But the point is when you're doing accounting, you're always supposed to be accurate. So with that said, rewind the video, watch it again in order to see how the numbers are arrived at, and think through the solution. And if you have any questions, go back and watch the theory videos if you're not understanding how the ratios are put together. And if you have any additional questions, feel free to telephone and speak with an instructor.